Like, so one of the myths out there is tax deferral is always good. Always good. And what my comment to that is not necessarily. Oh, Brent, tell me what's transpired in your life since 2 weeks. It's crazy how fast these 2 weeks go.
Yeah.
It seems like we were just here talking about the Snowmageddon, which was still out.
Yeah, there's still snow. I think today
snow.
is the first day where it's gotten above freezing.
Yeah, 52 degrees according to my car. So, you know, but the snow still, there's like mountains of it, and it's going to take forever to melt.
It was the biggest pain in the neck. We're in a big home organization project at the house, so I've got people like taking everything out of the boxes in the basement, organizing it all, and then putting all the boxes back. And we had gotten everything to the place last Friday where we had just piles of junk. And well, I say junk. Some of it a good chunk of it we're actually going to donate, and then some of it will have to get junked, and that relates to our story on taxes today. But anyway, the junk people were getting ready to come on Friday, and then of course we got 3 inches of snow last minute. Nobody could get down my driveway, so
that came out of nowhere.
So piles of junk all over my house all weekend during the Super Bowl. It was great. So I actually think the people are there at my house as we speak, getting rid of all of the stuff. So thanks to my wife for taking care of all of that.
Yeah. Oh, there's something to be said about being really organized. I have to say one of the biggest freedoms you get by being organized is the ability to park in your garage. You always know, like driving down in your neighborhood, you know, who's organized and who's not by who parks outside of the garage.
That's a great point.
So if you get both cars in your garage, you're probably a pretty organized household.
Well, I'll say that this snow was great for me in the sense that I knew it was coming, and so it forced me to organize my garage. I had junk in the one side, and so we got it all straightened out and managed to get the car in the garage. I figured I was going to spend that same amount of time cleaning the car off anyway after it snowed, so I might as well use it for something that was materially productive.
Yeah. Well, you're kind of forced to keep your garage organized because otherwise it's going to be tough to plug in your car.
I could do it on either side. So
that's true. So we've had a lot happen. So the Super Bowl happened. Did you watch that?
Oh, man. That was kind of a brutal game.
Yeah. I found it to be incredibly boring. So I watched the first half and then I kind of lost interest.
Yeah. Well, I think you and a lot of people.
Yeah. I'm not a big football guy anyway. I don't watch a lot of professional sports. I see why people do. It's definitely, there's a lot of talent there and it's cool to watch, but it just doesn't there's something missing in my brain where it doesn't keep me glued.
Yeah.
You know, I actually find it to be, I got this feeling taking my son to his basketball game. They had a really close game, and these are just, fifth graders playing, and it wells up like an anxiety in you that I cannot explain why that exists. What difference does it make to my life? Who wins? Why is it that I feel this welling up of anxiety about the game? And I started to get introspective about it. And I'm like, why do I feel this way? And I never came to any conclusion. It's just innate. And I don't like that feeling. I don't like the way it makes you feel. It gets you angry when things don't work your way. And maybe that's what, pushes me away from this stuff.
See, I like it because it's you can have a great excuse to have some people over.
Oh, that's true.
Make a bit of dinner, have some fun. The game is, a game is great because you just don't have to be glued to every second of it, but you can watch it at the same time. And so I just think it's the right level. It's just so hard. I'm not going to sit down, bring you over, and then watch a Netflix series with friends at my house because it's just too intense. The game it's like watching the news. You can keep it on in the background.
Yeah, there's a lot of dead time.
Yeah.
Which is how they pack all those commercials in. What did you think about the commercials?
That's, I was... I'm a 90s kid, and I just feel like millennials. It's so interesting because the world, I think, as the baby boomers were growing up, the world kind of coalesced all of its marketing power around baby boomers because of how big they were or how large their generation was. And one of the things we've talked about on this podcast is that the millennials are actually a larger cohort now than the baby boomers. And so if you look at all the commercials, it's I think the winner of the Super Bowl was the Backstreet Boys. Because there There were T-Mobile commercials with the Backstreet Boys, and then the Coinbase commercial. Did you see this one?
Yeah, I didn't understand it though. Wasn't it just text?
It was it was like very quiet. They played music quietly, softly in the background, and the text was like karaoke text.
Yes.
So they basically prompted everybody to karaoke in their living room. And it was genius because they, everybody's interested in it. Like it's always the ads that are like unique. I remember a couple of years ago, there was an ad that was just completely silent. And like that ad got just a ton of attention because the fact that you're hanging out with your friends and there's all this white noise and you're talking, just like we just said about the game, and then all of a sudden the noise is gone.
Yeah.
And everybody looks up. And I think that was exactly what happened in our situation is the noise was gone. All of a sudden we looked up and we realized, oh, it's karaoke. And then everybody's kind of humming along.
I didn't. Until you said that, I did not get that. That's how slow I am on the uptake sometimes.
Well, and then you're sitting there, the whole commercial, going, "This is kind of cool. Like, who's doing this commercial?" And then at the very end, you don't know anything about who's doing it. And at this point, I'm thinking it's T-Mobile because I've seen 2 T-Mobile commercials already with Backstreet Boys, and then it says Coinbase, which was. I just thought that was kind of cool. And then my other favorite one, just while we're on commercials, was did you see the commercial with all the 90s?
Okay, so this one. Now, there's a certain person in my household, I'm not going to name who, they were like, oh my God, Jennifer Aniston looks so good right now.
Yeah.
Oh, he looks so good. And
Hi, I'm Tom.
And then I'm kind of looking over, I'm like, someone's completely unaware of AI.
That's hilarious.
Yeah. And then finally, who's the guy, the actor with Cheers? I forget his name.
Oh gosh, I don't know that. I talked about advertising to millennials.
But he came on, and then finally it clicked. It was like, it's AI. But yeah, there was a lot of AI generated content in the commercials this year.
AI companies dominated the commercial. Like last year, it was all about crypto, and this year it was all about AI.
Well, I tell you what, Coinbase could use the customers right now.
Well,
crypto is getting murdered.
Coinbase isn't a great example, I guess, but like, what was the commercial? I think what was it? Anthropic had a commercial just ragging
Claude.
on.
Yeah,
they ragged on
ChatGPT.
the
target, the implication was it was ChatGPT that was supposed to be the muscly guy. And the funny thing is, ChatGPT has not integrated advertising yet. It's going to, and when it does. It's finally going to turn a profit. But I think Alphabet, Google's Gemini is going to be the first one to actually do it and do it successfully. But Claude, I don't know, man. If you don't have an advertising strategy behind your AI tool, I just don't think people are going to use it. I like the idea. I would pay to avoid advertising because I like the objectivity of having paid the subscription fee and removing the advert element of it. But most people don't do that. Most people are happy to, pardon my French, whore out their attention for free. They're like, is it free? No, there's actually a lot of advertising. I don't care. Sign me up. That's how most people are. And I think that's how I think Alphabet's going to probably win the race for that consumer direct, like AI.
Just because they own the data.
Yeah, well, they have the advertising model figured out. They've been implementing it for decades with Google, and people still use Google. They're still the king of search. And OpenAI to a lesser extent, because OpenAI kind of has a little bit of reputation damage due to some of their they have, from what I understand, kind of a hostile work environment.
Yeah.
It's not as friendly a place to work, and I think it comes partially because of Sam Altman converting it from like an open source nonprofit project, and now it's like obviously for profit driven, and that's bled into the culture a little bit, and I think OpenAI has lost a lot of goodwill with the public as a result of that. Not like the large. I'm mainly talking about the people in the know. So I think that if OpenAI is the first to kind of fall on the advertising sword, they're going to suffer too much. So my guess is they're just kind of waiting for Alphabet or Gemini to implement it, and then they're going to follow suit.
Well, they talked about putting it out there. But
they have to.
They came out and clarified after the Anthropic ad, I believe, that Anthropic had the way they were going to go about it wrong. And then you saw the AI.com commercial where at the end of it they kind of ripped on everybody. Pick up your AI.com, and they like AI.com/Sam, AI.com/Elon. Like they trolled everybody in that commercial. So I don't know. It was the commercials were definitely like I said at the beginning. Now the millennials have kind of become what the baby boomers were, where I think a lot of the advertising for consumers is really targeted to those
nostalgia
of us.
bait, man. Yeah, tons of nostalgia.
90s everywhere.
Honestly, it started with the first episode of the sequel of Star Wars in 2016. I think it came out. It was like, it had they brought back the old crew and. Everybody was all glued. That's when I think the tide turned. To
Don't get me started on the coming back.
Sorry. Let's move on. So S&P 500's up almost 2% year to date. Some interesting things happened there. You had an observation coming into the
podcast. We talked a lot. I mean, concentration. Like everybody was ripping on the indexes last year because of how concentrated they were. Oh gosh, the top 5 companies are 30, 40% of the index. And what I just find so amazing this year is like if I could go pull up multiple stocks on a year-to-date basis here just for, good measure. And we've got like Google or Microsoft is down 13% on the year. Mm-hmm. If I add in here, like Google, Alphabet, down or only up 1.5. If I could go down the list here. I guess I won't take us through it. But the point is, if you look at the Mag 7 companies, they're not doing that well on a year-to-date basis. But the index as a whole is still up 2%. And that's amongst a backdrop. I mean, we talked last episode about what was going on with gold. That's since completely reversed. I mean, gold, I think, peaked at almost 5,800 an ounce and then sold off about 20% the next day. Bitcoin is down. Bitcoin bottomed at like 62,000, I think.
Getting slaughtered.
Which was it peaked at 120?
125.
So it's down. Yeah. I mean, we're officially down 50% in Bitcoin.
Yep.
Like all of these things, if I just told them to you in a vacuum, seem very weird. And here we have the broader U.S. stock market just cruising around right at all-time highs, up 2% on the year.
Yeah, the what's pushing the index up, I did a quick search on this. So the biggest contributors year-to-date so far, Micron Technology, Lam Research, Seagate Technology, Western Digital, Applied Materials. Finally, a name that most people know is Intel, and then number 7 is NVIDIA. So we have to go down to 7 names before we get to one of the Mag 7 being a major contributor to the index performance year to date. So what we're seeing is a broadening of performance.
And we talked about this. We talked about last year, we talked a lot about how if AI was really going to work, like we're going to need to see some of these other companies. Those first 6 companies you listed, I haven't had any clients. I mean, I've had a lot of clients in the last year or two call me asking about buying AI companies or buying tech companies. None of those first 6 or 7 you just suggested were at the top of the list for client buys.
Micron is up 46% so far year to date.
Micron is a crazy one.
Yeah.
I mean, if you've watched that stock over time, it goes through booms and busts.
Oh, my God. Yeah, you got it. I mean, you got to have a roller coaster harness.
Well, the GPU
hold on to that
cycle,
guy.
like the GPUs that they produce, go through cycles, and so it's just very boom and bust. But they've hit the sweet spot with some of this AI, infrastructure demand.
So we got the S&P up. You were mentioning some technical indicators implying that in the near term, we could see a nice pop from it. Granted, I'm not much of a technicals guy, so I don't really. I pay attention to them to the extent that they're interesting, and I think that there's so many people that follow technicals that it actually bleeds into fundamentals in some way. So you almost have to pay attention to it. But long term, I don't really see how technicals play out in investors' favors. Like I'd rather, personally, how I invest is I buy high quality investments and I just hold them. I don't bother trying to get in and out of them. But like some people, they want to get in and out, in and out, in and out, and they pay nothing. All they do is pay attention to technicals. And who's to say who's going to outperform? I will say my strategy is a lot more dependable and a lot easier, a lot less subject to emotional compromise too. But did you want to go over this?
Well, nothing crazy. I mean, I agree with everything that you just said. Ultimately, investing is a long-term game, and you don't want to be trading the portfolio back and forth. At the same time, anybody is really forced from time to time into timing markets. I mean, we as advisors believe that timing markets is not a sound endeavor over time, but inevitably as you're buying or selling, there's an element of timing that goes into it. And so, as I'm working with clients, let's say I have somebody who's retired and living out of their portfolio, inevitably there are moments where we've got to get in and sell things. Mm-hmm. And, we can sell on a monthly basis. And that's what we do with a lot of our clients, is simply sell on a monthly basis. But in moments where stocks are, if you have a week where stocks have gotten sold off 5-7% in a week, do I just want to mindlessly go in and raise cash that day? Or is there potentially an advantage in being a little bit patient, waiting for an up day, and then taking some profits? So I just think I agree with everything that you said long term about staying invested. I think that should, of course, be the core. But we try to have an awareness on, where are markets, how strong have markets been relative to the past? Are they overbought or are they oversold?
Sure.
And those things can inform some of the investment decisions around the fringes.
Yeah. So finally, we have the jobs report that came out, and it was kind of like, blah, nobody really cared. Continuation of the low hire, low fire jobs data. So there was really nothing major to report there. But I think your point about market timing and being something like you should do upon entry points and exit points, not necessarily, it shouldn't govern your entire strategy, is a perfect segue over to our story of the week, which is the Oracle of Omaha, Berkshire Hathaway. So let's talk about how he ended up with Berkshire Hathaway in the first place, which is actually originally a textile firm.
Yeah, this was just kind of a fun story that I came across over the weekend, and you and I both really like Warren Buffett. Mm-hmm. I mean, a lot of the things.
We got his book right here.
Yeah, that's true. And I was really sad. He's not writing his annual letters anymore, which is just really sad because there's so much good stuff. If you go back through Warren's annual letters every year, there's so much good stuff in that, and we will continue. I mean, we'll reference those through episodes on the podcast because he does have a lot of really good things to say. But yeah, I came across this interview. Becky Quick is one of the CNBC one of the CNBC reporters on Squawk Box every morning, which is one of my favorite shows. And Becky has always been really close with Warren. She's kind of the reporter that he has a good relationship with, and she does a lot of the interviews. And I think this just came up on, I was flipping through Facebook. I forget even how I saw this, but the question to Warren was, "What's the worst investment you ever made?" Mm-hmm. And you know what his answer was?
It was Berkshire Hathaway.
Berkshire Hathaway.
Yeah.
And I of course that's somewhat ironic. So then the question is, well, how did that happen? So he goes on to tell this story, and I'm sure I won't do it the same justice that he did, but I guess the way it goes is back in 1962, Warren's famous for talking about how he used to buy what he calls cigarette butt style companies, like companies that were cheap on the basis of cash flow, but were really crappy businesses, and they were cheap for a reason. Mm-hmm. And he was bottom fishing. And so Warren is out there buying shares in this textile business in 1962, Berkshire Hathaway, who's closing up manufacturing plants. And Warren's basically buying the shares, and then as they're closing up the plants, and so the Berkshire Hathaway sells a plant, they've got a bunch of money, and they have to decide what to do with the money. So instead of expanding operations because the business is struggling, they're going and buying shares back from their shareholders, and Warren Buffett is having fun buying their shares and then reselling them back to the company at a small profit. And the story goes that Warren shows up to talk to the Berkshire Hathaway CEO at the time, and the CEO says, "Hey, Mr. Buffett, we just sold one of our manufacturing plants. We'd like to buy your shares. Will you tender your shares to us?" And Buffett says, "You have my word that if you offer put a tender offer out at $11.50 a share." Okay, now we could go pull up the price of Berkshire Hathaway today, but $11.50 a share. You have my word that I will tender all my shares, sell them back to you. So you know what happens? Warren goes home. He gets a letter in the mail from the powers that be, and they, in fact, have offered him a tender offer on his shares. He said he'd tender everything at $11.50. They offer him 11 3/8, which I don't even have the exact math, but it's an eighth of a dollar underneath 11 and a half. So they kind of screwed him for an eighth of an eighth.
Yeah.
And but Warren Buffett was so PO'd about that he didn't tender his shares.
Yeah.
And then he turned around and actually bought more shares to the point where he bought a controlling interest in the company and then fired the CEO and took over Berkshire Hathaway. Now, back to the beginning of the story, why was it the worst investment he ever made? Fast forward to, I think it was 1964. He bought, I think it was Geico, right? He bought the insurance company.
Yeah, I don't know.
But he bought the insurance company, and that ended up being that ended up being the whole basis for Berkshire, right? They bring in money through insurance premiums. They use the insurance premiums to make investments, and then they pay out the insurance claims over time. And along the way, Warren Buffett tried to save the failing textile business to no avail. Yeah. And so Warren quantifies it, and he says that if he had taken the same money that he had used to try to save the failing textile business, and he would have just not worried about that and just put it in the insurance business, he'd have an extra $200 billion today, or the company would work.
Yeah, it'd be worth double, right?
So he basically views that as a $200 billion mistake, and which is hilarious because if you look at the price of Berkshire today from $11.50, I think my takeaway as what we always preach through diversification is that look, it's okay to own some of the companies that are going to lose because long term, the winners are going to more than pay for the losers. And I think that was kind of what I came away with is, gosh, $200 billion mistake, but look how much money he still created out of this. And, maybe it was good or bad, but nobody knows the future.
Yeah, it's kind of, I don't know if it was a mistake because if he hadn't done that, maybe he wouldn't have had the fire under his seat. There's a lot of
what could have happened.
Yeah, I think he was being kind of coy when he said it was a mistake, but it's a great story nonetheless. It actually, a couple of years after he did that, he and the board elected to pay the one and only dividend in 1967. Berkshire Hathaway issued one dividend in the entire history of Warren Buffett as CEO of Berkshire Hathaway, and he describes it in his 2025 newsletter, which is a great way to get into our main topic, which is tax myths. So I am going to have a segue here, but he says on January 3rd, this is, by the way, this is 2025 shareholder newsletter. On January 3rd, 1967, we dispersed our sole payment, $101,755 or a 10-cent per A share dividend. I can't remember why I suggested this action to Berkshire's board of directors. Now it seems like a bad dream. So why did Warren Buffett, why does he not particularly like dividends? He likes all that capital reinvested into the shares, reinvested in the company. So it drives share appreciation, growth.
Well, let's go back to his story about tendering the shares.
Yeah.
I mean, if you get extra cash as a company, what gives you more confidence as an investor if they're taking that cash and being opportunistic about it, or if they just, I think a lot of the criticism of companies that pay dividends or do buybacks is you didn't have any better idea than just paying it out?
Well, yeah. I think Berkshire Hathaway is a little different because right now they're sitting on record loads of cash, and you could easily make the argument over a certain period of time, especially 1 to 2 years, that value would be better off returned to shareholders. I think the main reason they do this is because there is tax optimization. So, if they pay out the dividend, that becomes a taxable income to all the shareholders. And I want to use that as a segue into the main topic today, which is, the top tax myths that stress everybody out. One of those tax myths that I encounter a lot of times, we actually had a big argument internally in our organization between me, you, and another advisor, Matt Heitman, about tax deferral. So one of the myths out there is tax deferral is always good, always good. And what my comment to that is not necessarily. In the case of Berkshire Hathaway, yes, it is, because there's what's called a step up in basis on capital assets. If you hold, here, this is actually true. People don't realize that this is true. Let's say you buy a share of a company, let's call it NVIDIA, because NVIDIA has done really well. You put $10,000 in NVIDIA in 2008. That's probably worth like $1 million today.
Yeah,
all
easily.
right. So let's say you put $10,000 in this stock, and then 15 years, you close your eyes for 15 years, and then you get your statement and you look at it, and it's worth over $1 million, and you're so elated that you have a heart attack and you die on the spot right there. All right, you've got $990,000 of gains that's never been taxed. What happens in that moment? Well, because you died, the IRS gives you a pass. You get a step up in basis. Your beneficiaries assume that tax cost basis, which is $1 million on the date of death. All right, so in that case, the deferral is good. All right, now let's look at what's called,
By the way, just to interrupt, do you know what $10,000 of NVIDIA?
I don't even want to think because I put my whole Roth contribution in NVIDIA in 2007, and I struggled to. I did the math on it.
I'll just put it on
the
screen for the listeners. You don't have to look.
Yeah, don't show me. Anyway, but tax deferral, in other cases, it doesn't necessarily work so well for you because you create what I call a tax time bomb. So anything, what the IRS calls IRD assets, so it's income in respect to the decedent. Things like, tax deferred annuities, tax deferred like IRA contributions, things of that nature. These things, the tax liability passes on to the beneficiaries, and then they a lot of times they're just ignorant and they just withdraw the whole thing and they get a surprise at the end of the year, and it gets ugly. But
well, your point, like let me give a good example of this. Okay, so I work with a lot of business owners where they will set up a retirement plan for themselves and their business. These people are in typically high tax brackets, and I don't want to dog on this tax deferral because it can be really good, but I think there's a lot of tax people that will say, hey, make this retirement account contribution. Let's say you put $50,000 in your retirement account. That contribution works as a deduction. Let's say you're in the 32 or 35% tax bracket. That $50,000 could be worth, just rounding math here, $20,000 back on your taxes. And that $20,000 back feels really good today, right? Because that's $20,000 you didn't pay because you just put that money in your account. And I'm all for that. That can be a really good thing, especially if your tax rate goes down later. But here's the problem is that money, though it's not taxed today, it is going to get taxed one day. And so really by focusing on saving the $20,000, you're only getting half the picture.
Yeah.
One day you take that money out, and I don't know what tax rate you pay on it. Maybe, hopefully, you pay a lower tax rate. And I would say for a lot of the clients we work with in the top tax brackets, that's a pretty reasonable bet, depending on their plan. But, you have a lot of people today, the 22 and 24% tax brackets go all the way up for married filing jointly, almost to rounded numbers, about 400,000. Those are pretty favorable brackets historically. And, if you're deferring money today and not paying taxes at 22 or 24%, hoping that some point in the future you'll pay less.
Yeah.
Maybe. But the point is that it's not a true deduction because it's a deduction today to recognize more tax later.
It's kicking the can down the road, and that's not always a good idea. I think people just default that it's always a good idea, and accountants especially fall into that pattern. I think that's the myth I want to dispel.
Well, and not to beat on accountants a little bit here, but I think, when you're charging fees to do the planning, it's really good to be able to say, look how much money I saved you. And sometimes, that savings, it's like you got to make sure that you have the whole picture. There's some savings that's really true tax savings.
Well, there's lifetime tax bill, and then there's today's tax bill. The two are not the same.
Agreed. That's a good way to sum that up.
So the next myth that I wanted to dispel, which is a little bit more basic, but people don't realize this, it's there actually is no requirement to file a tax return. Now, you should file a tax return. All right, I'm not saying don't file a tax return, but there's no requirement to file a tax return. There's a requirement only to pay.
Pay your taxes.
So you can actually pay. You can ballpark. So if you think paying your taxes is a pain in the butt, just overestimate how much taxes you're going to owe and file, and just send that money to the IRS and call it a day. There's nothing wrong with that. You can do that. Now, here's a couple
Hopefully
reasons.
You got it right.
Yeah, hopefully, because you don't want to overpay. You definitely don't want to underpay, though. I would rather overpay than underpay, because underpayment, Al Capone will tell you, is not pleasant. Actually, he won't tell you because he's dead. But I think that that's important to know, is that there is no requirement to file return. Now, coincidentally, all right, I got to say this as an anecdote. I know someone who has never filed a tax return. This individual is in their 60s.
Okay.
Never filed a tax return. And people say, well, were they married? No. Single income earner their entire life. I'm not going to say what they do for a living. No.
So there's no tax withholding?
Self-employed, cash in the pocket. Not even cash, checks. There's a paper trail here. And I've told this person, you better correct that. That is a problem. And I'm going to tell you why that's a problem. Here's the main reason you want to file tax return. If you the statute of limitations in the IRS is how many years?
3.
3 years, except for fraud. Fraud is unlimited. But most people are, I don't think, committing fraud. All right, so it's 3 years. You file your tax return, the 3-year clock starts. If you don't file your tax return,
there's no clock.
There's no clock. There's no statute of limitations. So this individual can be audited all the way into the very first workday. Now, I don't know how you would do that, because, I mean, there's the paper trail can only go back so far. But, file your tax return. Always file. And I know a lot of Social Security recipients that just don't file. I still say file. File, even if you're not going to get a return, still file, just because of that. You never know. I was meeting with a person yesterday, so I'm sorry getting off on a tangent here. And they got a letter from the state of Ohio saying, hey, you owe us $3,000, which that means that there's like $100,000 in income that, the state of Ohio says this person has. And
this is like roughly a 3%.
But they don't have a federal return to send the state of Ohio to show as evidence that, hey, that's not true, because they haven't been filing. So it's a good idea to file.
Yeah, I would say, just practical tip here. I mean, one of the other things that I really like to do is on my computer, I create a file for myself. And if you haven't done that, I mean, I imagine most people have done this, but if you haven't, create a file folder for yourself on your computer, and within that file folder, create a taxes folder. And make sure this thing is secure and that it's not, not available to nefarious parties. But start saving things. Like a great example, I'm doing this junk removal from my house. We have a bunch of stuff that is getting donated. I'm going to be making sure that we get deductions for what's donated. And, I've created a whole folder within inside my taxes folder. I have a 2026 taxes folder, and then within the 2026 taxes folder, I have a charitable deductions 2026 folder, and it just has. I mean, this was really not that hard to do. I went around my house to the piles of stuff that we're going to donate. We took pictures on my phone. So I have pictures of everything. I then included the pictures in the file folder. I put together a really simple Excel spreadsheet that included what was donated, the rough value, where it was donated, what the tax ID was. And I can now forget about it until next year at tax time, because there's a system in place that works me back to my documents, right? And I think for me, like, all of the tax returns should be in there, all the supporting documentation for the tax returns, because there are times, I mean, people think the IRS gets things right. The IRS is not, they're not the most coordinated institution out there.
Well, that's the other myth that I want you to touch on, you brought in, is...
Well, this is one of my beliefs. I mean, this is one of the things that I work with a lot of my clients. So in our practice, we do a lot of, I'm not a CPA, I'm not a tax preparer, I can't give tax advice, but we can talk a lot about strategy within your personal financial situation, how taxes are how that strategy impacts your tax situation, and how to lower, as you talked about, your lifetime tax bill. One of the most common things that I think I come into, or one of the biggest areas of opportunity for me as an advisor, kind of connecting the client and their CPA, is the fact that the tax forms themselves don't tell the whole story for your tax situation. So many clients just get a 1099, get their W-2, and they just assume that everything, the CPA can figure everything out from just these forms. And I think what's really, the bottom line is that's not true.
Yeah.
These tax forms, there are just certain things that aren't included. and kind of having just a little bit of knowledge around like what additional info might the CPA need so that they can file a proper return, it can make a big difference in how much you owe.
Absolutely. Yeah. So, tax forms don't tell the whole story.
And just quick examples of that. Anybody doing a backdoor Roth IRA, that is really easy to screw up. People getting restricted stock that's vesting from work, really easy to screw up. People donating money out of their IRAs, easy to screw up. There's just borrowing money against an investment account and paying interest on that. That's potentially deductible, but nowhere on a form is it laid out.
Did you know student loan interest is deductible even with if you're using the standard deduction?
It's an above the line deduction.
Yeah.
Yeah.
So that's another one.
Technically, people haven't paid student loan interest for years. That's we're
true.
Back to it.
All right. So that we've gone over 4 myths so far. So the fifth myth is, this one is one I like, and that is, there is a natural aversion to filing extensions, and filing extensions is not a bad thing. In fact, it's a good thing. And I encourage everyone by default, just tell your accountant, file an extension. That doesn't extend your payment responsibility. You still have to pay your tax liability or an estimated amount on April 15th. But filing an extension is typically a good thing, especially if you have complex returns, because there's a lot of forms that don't come out until pretty late. K1s, a lot of times, they take forever. It seems like I'm waiting until summertime for my K1s. But also, too, you get more time and attention from your accounting professional. So, and the IRS doesn't care. In fact, I was listening to a podcast. Don't hold me to this, but I believe it to be true. The logic is sound that if you file an extension, your odds of being audited are less. Now, I think the reason for that is because people who have extended returns are more accurate with those returns, and therefore they're less likely to be electronically audited.
Yeah. I might have one caveat to that rule. Like if you're expecting a big tax return, like I think the benefit is like filing. So if you don't, if the government owes you money, you are not getting that money until you file the tax return with them and ask for it back. So you made the right point, which is that the extension is not an extension to pay. It's an extension to file. So if you in fact owe taxes at tax time, you're not getting anything back, so you're not worried about filing early to try to get your money. You're not going to get away from paying them in April, so you're still going to have to make a payment in April. Kind of back to your point before, you're trying to make a payment that is big enough to cover all the tax liability, maybe with a little bit extra, and then you're going to, I don't want to say figure it out later, because hopefully you've done some figuring out at that point, but you're going to you've now got the rough draft that you've extended in April, you've made your estimated payment, and you're going to go back in May or June, which to your point, the CPA is not as busy in May and June, and now you're going to get more personalized time and attention to make sure the return is correct. You're going to actually file it, and let's say you overpaid by $1,000, that money comes back to you.
Yeah, so that's good. You want to get your money as quickly as possible, but I think don't be in such a hurry that you don't allow enough time to receive all your tax forms. So moving on to the next myth, which it's surprising how often we get this, but we get it a lot, and that is tax brackets apply across. The myth is tax brackets apply across all your income. So here's what else. Here's the example. Oh, I'm in the 24% bracket. Therefore, I have to pay 24% of my income to the IRS. That's not how it works. Tax brackets are progressive. So what it means is that the more money you make, the higher your tax rate becomes. So the first $10,000 you make is typically taxed. So it's like $11,000 some change. It's taxed at 10%. An amount above that up to, I think, what was it, 45,000, 46? I'm married filing jointly is what I'm. Yeah, you pull it up.
I'll pull it up now here.
Yeah. So as you make more money, that additional money, that incremental, the incremental money applies to this tax rate, not the whole amount. So it's not like, for example, here in this on the screen here, if you make $47,150, it's all 12%, and if you make $47,151. Because I made that extra dollar. Now 22% applies to my whole income.
The point is that from $0, this is single. This is also using 2024 tax rates, but it still demonstrates the same point. the first bracket is 10%. You pay 10% on your income up to $11,600. Then from $11,601 to $47,000, you're at 12. Then the income above $47,150 is 22, up to about $100,000. Then it goes to 24. Just for practical application sense, we do a ton of planning with clients in these 22 and 24% brackets. Back to the point earlier about being careful around tax deferral, these brackets are pretty generous relative to history. And so from our perspective, there's a lot of planning that we can do to accelerate taxes, to actually pay taxes in the 22, potentially 24% bracket where they are. Where you really want to be careful is that after you get above this 24% bracket, I mean, the jump from 12 to 22 is obviously a big jump.
Yeah, it's huge.
But that's at $47,000 of income. Most of the clients that we work with are kind of in this 22, 24% range, but the jump from 24 to 32, that's another really big jump.
Well, that one hurts too because it applies to like $91,000 in income.
And it just so happens, like these are just the rates themselves. There are other things that you phase yourself out. Like the tax code is full of what are called phase outs, which basically means that once your income gets above a certain point, they start taking other things away. So $400,000 is a great example. For married filing joint, $400,000 is the top of the 24% tax bracket. It's also where they start taking away your child tax credit if you have children. And it artificially increases your tax rate. Trick question.
It doesn't feel artificial.
Well, I maybe artificial isn't the right word. It's a tricky increase because you don't see it. It looks like you're in one bracket, but your actual tax rate, because that dollar isn't just getting taxed, it's phasing you out of other deductions.
Increases your effective rate. Yeah.
Right. So here's the one question is there is one thing in the tax code where an extra dollar of income, because to your point around being progressive, this is why you would never say no to a raise. Because, like, yes, will a raise increase your tax? Will your new income be at a higher rate? Maybe, but it's not going to increase your taxes as a whole. There is one place in the tax code where an extra dollar of income, where taking that raise, so to speak, does cost you more than you might make, or could cost you more than you make. Do you know what it is?
I was going to think alternative minimum tax, right?
No, it's Medicare premiums.
Oh, that's true. Yes.
Right? It's IRMA.
Yeah,
so if you are on Medicare, the amount you pay for your Medicare is based on your income. And there are specific brackets for that. So if your income goes $1 above a certain level,
it's true,
then your Medicare premiums could increase by thousands of dollars. And so when we work with retirees, that's a huge piece, is just making sure that, really what you're trying to do is just make sure you don't end up a couple dollars above these things.
Yes.
Because that can be, because that's also a really uncomfortable one, because every year they send you a letter. Like you get a letter at the beginning of the year and they say, hey, and they only know their most recent
and
filed
the
tax
letter
return.
actually does start with hey.
Well, the letter basically says, look, here's the income we had for you for your most recently filed tax return, which is the prior year.
Yeah.
So like right now, it's all based on the 2024 tax return that was filed in 2025. So they're sending you a letter that says, hey, look, here was the income we had for you for 2024. Based on that income, here's your new Medicare premium.
Yes.
Now, and by the way, if you're on Social Security, a lot of times it's just deducted out of your Social Security. So, this is why a lot of people that get Social Security complain that every year and maybe this is a Social Security myth, people believe that the cost of the medical on the Social Security goes up by enough every year to offset their cost of living adjustment on Social Security. So Social Security doesn't go up, because even though it goes up, the medical goes up.
Yes.
And it can if you really screw up the IRMA.
Yeah. You got to pay attention to IRMA. All right, so we got another myth here. One we forgot to put on here that kind of ties into this is we'll kind of put it as a sub note under the myth that the income brackets are not incremental, and that is, what about bonuses? Everybody thinks that bonuses are taxed more.
Yeah.
What's that all about?
I work with a ton of salespeople that get big bonuses all at once, and the myth is that the bonus has like a higher tax rate but you know what it is? It's not. Any wages, like wages have their own tax rate. Earned income is kind of the bucket they get put in. Any wages are all taxed in the same system. So it's not like a bonus versus, like, your bonus and your salary from the IRS's standpoint are exactly the same thing.
Yes.
The difference is your payroll system. Payroll actually annualizes the income and basically tries to withhold taxes based on an annual number.
Yes.
So what happens is the withholding tables hit the paycheck harder.
That's right.
And so it has nothing to do with what you actually owe.
Yeah, because it's measuring a higher effective rate for you.
Right.
Yeah.
It's annualizing your income. So
Exactly.
what's not happening is that your bonus is taxed at a higher rate. What is happening is that there's more withholding being applied to your bonus.
Because the system thinks that you're going to make that same amount every paycheck.
Continually, yeah.
So it kind of ratchets you up and,
And so things that, maybe could be good, like if there was if cash flow is your main goal, like doing a 401k contribution from your bonus versus your salary, no difference tax-wise. But in terms of the difference you'll see in your net paycheck, maybe the pre-tax 401k contribution won't feel as painful coming out of that bonus check because it avoids that heavier withholding.
Yeah, for sure.
But you have to be careful because you also want to make sure you don't lose match and things like that. And that's one of the things we help people with.
All right, here's another one. And this one kind of I hear a lot. And that people, that charitable contributions help you all the time. And that's not necessarily true. So, the charitable contribution, actually per the new tax law, which I think this is really good. So if you're making donations to a church or a charity, $1,000 in cash only donations, donor advised funds don't count, can be used in addition to your standard deduction. So what most people do when they go to file their taxes, they're choosing, okay, do I take the standard deduction, which is a standard amount? The IRS says, we're just going to pretend that you didn't make that. That's literally what they do. They just say, we're just going to pretend you didn't make that income. We're just going to cut it off the top of your adjusted gross income. So you either use that standard deduction, and that does vary depending on your age.
Filing status.
Yeah, and filing status. And then you've got your itemizations. And there are certain things that are deductible, what they call below the line deductions. So what they're saying is below the AGI line, adjusted gross income line. Things and charitable contributions are one of those itemized deductions. So if you're giving, let's say you're married filing jointly, if you're giving more than $2,000 to a charity, there is an absolutely zero tax benefit in doing that.
If you're taking a standard deduction.
If you're taking a standard, thank you for clarifying. If you're taking the standard deduction, and most people take the standard deduction because it's quite high, isn't it like $16,000?
Well, for single, and roughly $16,000 for single, $32,000 married filing joint. But this year, most people were not itemizing. Like Trump in 2017 talked about having most people file their taxes on a postcard. And the reason was because they were increasing the standard deduction up to like the $30,000 roughly married filing joint. And then what they did was they capped one of the largest itemized deductions, which was state and local taxes. They capped it at $10,000. So the main things that get itemized are state and local taxes, mortgage interest, and charitable. Those are the big three. So to your point, on a tax return, you add up all your income. Then you take what are called above-the-line deductions, which are 401k contributions, student loan interest, IRA contributions, HSA contributions, stuff like that, either $1,000 to charity or $2,000 that you just talked about in cash. And then you get to your adjusted gross income. That's kind of like the first page of the tax return is your income added up minus above-the-line deductions equals adjusted gross income. Then you flip the page over. And this is I encourage you, go pull up a 1040. Maybe we'll put one in the show notes if we're able. Look at the first page. It kind of works that it's got income that you add up at the top. Then you start taking above the line deductions. Then you turn it over. And basically you get two pathways. You either get the standard deduction, $16,000, $32,000 single married filing joint, or add up these categories, mortgage interest, charitable, state and local taxes. Well, again, up until this year, the state and local taxes capped at $10,000. $10,000. So a lot of people, especially when 2%, everybody in COVID refinanced their house, didn't have enough state and local taxes. They had $10,000 of state and local taxes, maybe another $10,000 of mortgage interest, and then a little bit of charitable. Well, add those things up. It's not $32,000. So I'm going to take the standard deduction. I'm going to get the bigger. Why would I take a smaller itemized deduction when I could take a bigger standard deduction? Well, now, big change this year. They increased the cap on these state and local taxes to $40,000. I think this is a big deal because it's going to, whereas before you had a bigger standard deduction and less ability to itemize, most people ended up taking standard deductions. I think we're going to see one of the big changes this tax season is that more people are going to itemize.
Well, yeah, what I tell everybody, I've created this strategy. I don't know if this is, I'm sure a lot of other people have thought about this, but I call it the itemization wave. And you can choose whatever, frequency of wave you want. I say 3 years, where basically what you can do is you can draw forward next year's property taxes into this year. You can do a donor advised fund contribution. Yeah, bunch everything into 1 year.
Concentrate deductible. If you're close to the line, as opposed to spreading things out into different years,
even if you're not really that close. I mean, you can.
Well, it just takes a lot of pulling things to get. Like, let's say you only could itemize 15 or 20,000, the standard's 32. Like, how much are you going to pull together? But I agree. I mean, for me, like, I'm going to itemize this year. Like, we just talked about the charitable stuff that I'm donating to charity. Yeah. That's all going to be taken as an itemized deduction.
I'm excited about it. I like the SALT cap being lifted. At first, I was not that excited about it, but then I started running the numbers.
Well, and one of the things that I'm doing for a lot of our clients that's really a new thing is that in a lot of these states, so we work with clients in several clients in zero income tax states like Florida, Tennessee, Nevada. None of these states impose an income tax. And in the past, like, most of these states have relatively high property tax. So the $10,000 cap was low enough to where my clients that were in Tennessee or Florida, they were paying, let's say, more than $10,000 in property taxes. So we could get them to that $10,000 cap. Well, now that the cap's 40, they're not paying 40 in property taxes. They can deduct 40, and they don't pay any state income taxes. So you made this point. We did a tax podcast a while ago, and you kind of alerted me to this, which is that it's not just state and local. The way the state and local tax deduction works is state and local real estate taxes. That kind of gets its own category. And then the other category is state and local income or sales tax. And so for a lot of the clients that we work with in states that have zero income taxes, where I know that they are spending more than $10,000, less than $40,000 of state and local taxes, we're talking to them about how to document their sales tax so that we can get a deduction for it. How cool is that? That's kind of a new thing that's come up this year as a result of the way this new rule from the new tax bill that we got last year.
Yeah, absolutely. Well, now, I think we're in dangerous territory here, becoming boring here, talking about taxes.
Right, well, I'll be quiet.
I think you and me, we could talk for hours about this stuff. I think you know that. And we gotta have ammunition for later episodes. There are actually, we've done 8 myths so far. I'll recap them later. But
my favorite one on here, one of my favorite ones.
Yeah.
Well, I shouldn't say favorite. I don't know if that's the right word, but I think this is one of the biggest ones out there right now. Is that Donald Trump in his new bill says no tax on Social Security.
All right, so we're doing 9. We're doing 9 myths. Yeah, I do want you to hit on this.
So, because I see it, it's out there. I mean, and look, I'm not trying to get political. I think we're fairly apolitical, but like I can see the news, and you see some of the groups on the right talking about no tax on Social Security.
Correct.
And a lot of the clients that we work with are taking that as gospel. They're on Social Security, and so they assume that they don't have to pay tax on Social Security anymore.
Isn't that sad? And I've heard him say that. And I've heard Donald Trump in his speeches say there's no taxes on Social Security. That is so misleading, because you would assume, I don't have to give this 1099 SA to my accountant then.
Yeah.
But what
actually happened was that they gave seniors a new deduction. Like, this is so obnoxious, right? Because seniors are like, we need to work on reducing complexity for seniors.
Yes.
Increasing complexity on seniors is like I guess it's great for us. Like, it's really great that we can talk about really complex tax cross currents to minimize somebody's tax bill when they're in their 60s and 70s and 80s. But the bottom line is now Social Security isn't tax free. Now you've got a new deduction that goes on your tax return if you're 65 or older, and it gets phased out. So there's a certain level of income where if you make over that amount, they take the deduction away, and then your Social Security is fully taxable anyway. So it's very misleading, and it's more complicated than it was before, and it increases complexity, not decreases. And I just think that's counterproductive.
Yeah, I agree with you on this, and it's painful to see how misleading the statements are about that. And I forget what senator it was that he was on CNBC or Fox Business, one of these shows. I forget which one senator it was, but he was on the committee that was putting together the One Big Beautiful Bill Act.
Mm-hmm.
And he got up on there and he was railing about, how seniors, they have to pay taxes on Social Security, and they should,
well,
they
I
shouldn't
think
leave
part of the reason that they didn't, I don't know the ins and outs, but there was some kind of constitutional reason that they couldn't not tax Social Security, if I'm right.
Sounds like
there was some, who knows if it was an excuse or not, but there was some
I think it was
technical reason.
I think it was Senator Ron Johnson, if I'm not mistaken. But anyway, don't quote me on that. It just was infuriating to me because Social Security, and that's not true. Social Security used to be tax-free in 1984. I forget what date it was, but it used to be, I think it was prior to 1984, it was tax-free. And then they put in these provisional income brackets, and it was designed where most recipients getting Social Security were not going to be subject to the provisional income brackets. And remember, the provisional income brackets that were installed they omitted inflation adjustments.
Yeah.
And now everybody's creeping into these things, and now most people have like an 85% taxable Social Security
it's pretty
benefit.
hard.
The whole thing is just absurd.
So like your Social Security is only 15% of your Social Security is taxable if your income's low enough, and then as your income goes up, it becomes 85% taxable, and you still have the senior deduction. So 85% taxable is really not taxable because you've got a deduction.
Yeah.
And then you eventually phase out of that deduction, and I mean, it's more complicated than it needs to be.
Yeah, and we do have Senator Ron Johnson to blame for that. So he was the guy, and he got on CNBC or something like this, and I was just like, oh my gosh, you're ruining it. By the way, this is another thing. It's not necessarily a myth, but it's a point. It's a point of contention. We pay income taxes twice on our Social Security because this is meant to be a retirement deferral. All right, just like a 401k.
Just like a 401k, yeah.
But that's not how it works.
Even your 401k contributions get hit with Social Security taxes.
Yeah, well, that's another issue. But Social Security, our Social Security deferrals, which is like, if you're self-employed, it's 15.2%. Isn't that right? Yeah, you got FICA tax, 7.65%. So it's 15.3%, sorry. So 7.65% is our deferral rate. Our employer puts in another double amount. And by the way, let's say if we just did that in the S&P 500, we would have like 10x what we get out of Social Security.
Yeah, I think
but I digress. That contribution we pay income taxes on. Right. So even though we don't see the money, we still are paying our marginal rates. Yeah. It infuriates me because when we pull out Social Security out of the Social Security Trust Fund, it's taxed again. We are literally double taxing that money. Anyway, let's move on to the.
I want to go one last myth. We've got the 10th myth.
So we're going to do
what
10.
It is. Do you know what it is?
Go for it. I don't know.
It's that we talked about it. This is amongst the W-2 people that I work with that make a lot of money. Mm-hmm. This is the number one myth.
Let's hear it.
Owning real estate can offset my taxes on my W-2 income.
That's a good one. Yeah.
So, I mean, it's just like, look, everybody out there, the idea of passive income. Mm-hmm. Like every client that we ever talk to is like, I have clients that make $400,000, $500,000, $600,000 a year and want passive income of $15,000 a year. It's like the concept of passive income sounds so great. And then on top of that, my clients that are making $500,000 plus are just, you talk about the bonus tax rates that hit their paycheck. They're getting hit with tax on their paycheck. They're looking down in December and realizing they've paid 6 figures of taxes, mm-hmm. and they're peeved.
Yeah.
Right. And so everybody's looking for some way to try to cut down that W-2 taxes. The problem is, and everybody's read a book that talks about real estate investing. Okay. And this is one reason you get an advisor is because like most people, when you're living your life, your exposure to what will make you financially successful is like a couple of stories that you get to reference. You get to see some parents, maybe some friends, yourself, maybe you read a couple books. Like the benefit of working with an advisor is we've worked with thousands of clients.
Most advisors, not every advisor.
Well, sure, but I'm just going to speak for us here. We've worked with thousands of clients. I've faced this question a lot. We've seen people not just say, hey, should I buy a rental to try to offset my taxes, or is this a good idea? We've seen people do it. And how does that play out? And so we can share that experience with you. But here's the gotcha, okay, is that if you are a W-2 earner, you cannot, there's rules around this. So you got to go look at the rules. It all relates to whether you qualify as a real estate professional or not. And qualifying as a real estate professional, there's two things that you need to do to qualify as a real estate professional. You know what they are?
Yeah, I do. I don't know if we should go in that level of detail.
Well, here's the most important one, and the one that sticks, or pushes so that my W-2 people can't do it. One, real estate has to be your primary job, right? So you're in sales, you're making $500,000 a year, you own one rental property, and you want to say that your primary job is your rental property. Like, that's hard to justify.
There's a certain hour threshold. I think it's
700 hours.
Yeah,
but the most important one
the
is
IRS will not let you. The IRS will just not let you say you can do that and maintain a full-time job at the same time. They say it's impossible.
So the point is, if you've got two spouses that are both working full-time, W-2 jobs, you can go buy as much real estate as you want. There are rules that keep you from taking any kind of depreciation against your W-2 income unless you can substantiate that real estate is your main job. It's your primary source of income, and you spend more than 700 hours.
And then there's all these buts and caveats, like, but Brent, what about short-term rentals? What about VRBO and all that? It's like, at some point it just becomes not worth it, And it's just, and also too, let's not kid ourselves. All this is doing is it's suppressing your income today, but creating a tax problem down the road. It's kicking the can.
Well,
you're not getting a deduction.
The issue, because back to our point of all deductions are good. When you depreciate real estate and you get a deduction against it this year, it's great. But what happens is eventually, if you ever sell the real estate, what you've done is you've embedded a larger gain in the property.
That's right.
So imagine you sell $1 million building,
and it's not taxed at capital gains either. There's
recapture rates.
Yeah, recapture.
So it's
rates.
higher. It's tough.
Here we go.
Here's the point. Let's just work through some simple math, though, okay? Because this is a real situation. Let's say you have $1 million building. I'm just painting the picture here, because this is how it. I've seen this happen. Client buys a building years ago. Over time, pay down the mortgage. Let's say they have $150,000 left on the mortgage. It's $1 million building. They're getting to an age where they don't want to manage the building anymore. They're sick of taking calls on the weekend about the plumbing breaking. They're sick of trying to vet out tenants to get them in there, whatever it is. So now they're thinking about unloading the property. And at this point, they've owned it for so long, they've depreciated it fully. So when they go to sell it, here's what happens. They sell it for $1 million. They pay a realtor. Let's just say $60,000. You pay off a mortgage, the $150,000 in the example, and then you get stuck with the tax bill on the $1 million gain, which can pretty easily become a few $100,000. So you look at this asset on your balance sheet. Hey, I've got $1 million piece of property, $150,000 worth of debt, and then all of a sudden you sell it and you walk away with, I'm just going to do the basic math, about $500,000. And you go, what happened to all my extra money? It's just like, back to the point, you're not really, the only way to avoid those taxes, back to your other point earlier, is to die with the real estate. If you die with it, you get to step up.
Not if you hire Jeffrey Epstein. We got to talk about Jeffrey Epstein.
Go for it. You are ready for this.
Yeah, man, dude. All right, so Epstein's all over the place. He's the hotness right now. And by the way, I don't want to make light of that. Like that guy, from if what is on these files is true, pure evil.
Yeah.
That guy is, it makes me sick, but his inroad, he's all the fascination, everybody right now. And, well, not just necessarily him, but like the whole apparatus and like who's tied into it. And, he had all these billionaires that as clients, and his inroad based on what we're reading here, was always tax planning. Peter Thiel actually went on record. He talked about this in the Joe Rogan show where, a while ago, he talked about this interview he had with Epstein, where Epstein was like couching all these different like tax strategies. But did you know Jeffrey Epstein was neither a CPA, he was not an enrolled agent, and he even have a degree. This guy was a high school graduate, college dropout.
It's not
just
what you know, it's who you know, right?
I'm like, how in the hell do you get to that level without any education? Like the whole thing is fishy. We're like, wow. So by the way, he was giving tax advice to these like billionaires. What was this guy's name? Larry Black.
Is it Leon Black?
Leon Black, on record, paid him $158 million for tax advice. When's the last time you paid your CPA $158 million?
Yeah.
Now, here's the problem with this. It's like, okay, was that actually a fee for service? Or was that just an outright gift that was skirting laws, the gift estate laws, the gifting tax laws? Because that let's face it, there's no tax advice out there that's worth $158 million. Come on. No one's paying that. There's no one that has that much lock on the code. You think he had some secret sauce? I'm going to tell you right now, he didn't. I know lots of brilliant accountants, and they probably know more than Jeffrey Epstein did about, how what he was doing is he was a confidence man. He would go in there and actually have a list. I'll put in the show notes here the different stuff that he would use. And these are all like common tax strategies that you and I might be familiar with. Let me see here. Well, one of them was the use. I'm going to just go in a couple of them. I don't need to go all of them. One of them was the use of GRATs. Grantor Remainder Annuity Trust.
Grantor Retained.
Retained. Thank you. Annuity trust. The other one was private annuities. All right. So what these things are.
PPLI.
Yeah, but really, in reality, these were designed more to dodge the estate tax. Something that billionaires have to worry about that most people don't is the estate and gift tax laws, generation skipping tax. These are
the real tax.
Yeah, these are the real tax. So when we talk about rich people escaping taxes, that's really what we're talking about. They're escaping taxes that don't apply to the rank and file. You have to be worth generally
like 30 million plus
to be subject to these. So what he would do is he would have you set up one of these entities, either like a private annuity or a GRAT, and he would have you donate appreciable assets into these entities. And what happens is you make sure that the donation into those entities consists of assets that you can discount.
Right.
So the IRS allows you these discounting rules. Like one of them would be, like it's thinly traded. Another one would be
it's illiquid.
Yeah, illiquid. There's an actual term for this. I lost it on my notes.
This used to be a lot more popular. The estate tax. The estate tax only applying to people over 30 million. Married filing joint is a relatively new concept. It used to be like 5. And so there was a lot more planning around it. Mm-hmm. And these discounts were used pretty the idea is that tax only applies to the stuff that's in your estate when you die.
Mm-hmm.
So this is why, like, if you have wealthy grandparents, this is why they're gifting you money every year, because they need to get that money out of their estate so that it doesn't get factored.
Yeah, so they're not being nice. They're just trying to
to get the money to you
I'm sure it's both,
before it gets hit with the taxes. So it's even more effective. So now there's only so much that you can gift every year before you get in. It kind of starts to get work against you.
Let's do an example.
Yeah.
All right, so let's say you have a private company. We'll call it the Money Alchemist podcast. I'm over optimistic. It's worth $100 million to us. Okay, it's worth $100 million, but we're key people. Right? What if we're not a part of it? What if I die? Or you die?
Then it's worth not much.
Then it's not worth not much. All right. So what we're going to do is we're going to apply a discounting mechanism. I mean, we'll call it 50%. So now it's 50 million. In reality, it's still worth 100. But it's worth 50. We put it into the GRAT that tax only applies on the 50. million.
Right.
So that's the kind of
So
discounting.
now you've saved yourself 40% tax
Yes.
on a $50 million.
All right, so that's one of the mechanisms Epstein would use, and he would be extremely aggressive. With
not
the
not
discounting.
$100 million is now worth $50 million. $100 million is now worth $1 million.
Yeah. All right, so that's one thing he would do. He would also use like these opportunity zones. Like the Virgin Islands apparently had this like opportunity development investment sort of deal with the U.S. Treasury.
And these were like government incentives. Like
Correct.
these were tax incentives offered to put your business or buy real estate or
Yes.
locate in an area that was considered high opportunity, maybe is the right way.
Correct.
To probably
And he was very knowledgeable about these opportunity zone rules and these carve outs and would abuse them. So basically, incorporate your business like these places in Minnesota that are just like, just shops with a business name on it, but there's nothing inside. That's what it would be. So you would have like these operations and these opportunity zones that were just nothing there but the channel, funds through. I bet the funds weren't even channeled through there. Basically, there was just the incorporated address of these entities, but the money stayed with like, the banks. So there were all these schemes. He would use all these schemes. There was no trick. All of it was I shouldn't say all of it, but a lot of it was just extremely aggressive accounting. And he was taking on a ton of liability for this as well. It got to the point, though, where so many wealthy people were reliant on him, though, that it almost became like like a debt, like a bank that has too much debt. The issue
too big
is
to fail.
He almost became too big to fail. Exactly, too big to fail, where people stopped. So they finally did away with them by arresting them and making it quiet, and they didn't even really talk about the tax evasion issues.
Yeah.
It was all about this, pedophile ring, which, that seemed
That's terrible.
like, as a human, I would say that is a bigger deal, and it's just that we as a culture are more.
But he hid it all
disgusted by
in
that.
his relationships with these wealthy people through the guise of
Tax planning,
strategies.
tax strategies. So yeah. Anyway, I just thought we should touch on that since it's like all the hotness right now, and we're talking about tax planning. So you wouldn't want Epstein as a tax planner, let me tell you. To Peter Thiel's credit, he kind of sniffed the bull crap.
Well, I think there's
said
a lot of
no.
lessons to be learned, and like be careful who you get associated with, and sometimes things that seem too good to be true might be too good to be true. You got to,
Well, what's not too good to be true is the tip of the week, and I think we need to move to that.
Well, I think it's timely. You brought this up.
Yeah.
You're the one that came up with this week, and you brought this up. And I've mentioned a couple times here. I'm in the middle of organizing my house. We've got all this junk that's getting taken out. Well, go ahead with your tip.
All right. The tip is we're all accumulating electronics, old electronics. Used TVs, used computers. It's probably why you can't park your car in your garage. What do you do with them? I went on this like big hunt a couple years back because I had like 2 or 3 TVs that were old and a bunch of used electronics. And I came across like an obscure advertisement from a local metal recycling company called Cohen Recycling. Now, they have locations all over. The one I go to is in Sharonville, Ohio. And for those of you who are out of Cincinnati, I just look up like local metal recycling. Maybe Cohen, it's Cohen. All right, so just on Monday, I accumulated a bunch of like used electronics. I went in there, they have the gate open. You can actually go in and park on the scale and go in and they'll weigh your car.
And then they weigh it after they take the
Yeah,
stuff out.
and then they weigh it after you take the stuff out. So you could also put like a 50-gallon drum of water and just empty it. Just kidding, don't do that. I thought about that. I was like, what? Kind of.
I'm sure you would.
I'm
get
sure
caught.
there's scammers that
I'm
do
sure
that.
they're videoing you while you do it.
I hope so. So yeah, they weigh you, and then you can go in and just drop off your electronics. I don't even bother weighing because like the stuff, I'm
It's
probably
not worth
gonna
a
get
lot.
50 cents.
Well,
so
all I know that we were on a road trip not that long ago down to Nashville.
Yeah.
We're driving down the highway and we see the other side of the highway like a big cloud of smoke. And it turns out there was a Rumpke. Rumpke's the trash company in our region. There's a Rumpke truck on the side of the road, just fireball. I mean, this thing is on fire. And you know what it is?
It's a battery, lithium batteries. Yeah.
This is a big deal right now. People are there's so much, like we've had electronics for so long, and now it's like 20 years ago when you bought a TV, these things were thousands of dollars. Or you bought a laptop, they were thousands of dollars. Now you can go buy a laptop or a TV for like a couple $100s, and then it becomes obsolete faster. And now, I mean, I don't know about you, I have old laptops and old TVs, and I'm paying the junk company to get rid of them right now.
Yeah, well, Cohen will take all that. So I don't know if they'll take lithium batteries by themselves. I'm sure you could call them and find out.
But they'll part it out.
Yeah, they'll take it. So you could bring your old cell phones, your old laptops, pretty much all the stuff with lithium batteries in it, and you just drop it off on a table, and they take care of it.
But don't put it in your trash can. Don't leave it in your basement for the next 10 years.
Don't do that. And a lot of times, like honestly, too, like let's face it, like it just goes out to, I call it Mount Rumpke. Like everything you throw away, it's just forever in that pile of that mountain. And what a shame that is, because like a lot of this stuff is reusable.
Yeah.
So you really should go, yeah, it's out of the way. You got to go drive it to there. But like, just go rent a pickup, go put it in the back of your trunk, go to Cohen, drop it off, and then call it a day. So that's my tip of the day. And, we had a couple of them. That was the one you
unfortunately,
for, so.
As we speak, I'm paying to have somebody take them away from me, so I won't get paid for them. I wish I had your tip of the week sooner.
Well, and that's what the people do, where they come and pick up your trash. They come and pick up like your appliances, these junk hunters. This is what they're doing. So, well, anyway.
Hey, this was great. You thought taxes would be boring, huh?
Yeah, it depends on how it's presented. So we'll see how many listeners make it through the whole episode. But I think we've got some pretty good clippable moments here.
Well, we're really excited to have video. So really, thanks so much.
We can break this up too. It'll be much more exciting for people who don't want to listen to the whole thing. We're doing clips now too. So shout out to Trevor. And
at what point, Ben, do I get to say please like and subscribe? When do I get to
smash that like button? We got a like button now.
All right. Well, thanks for listening.
Yeah. Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.